Hi, let's discuss the various approaches for assessing credit risk as explained in Ind AS 109. These approaches are essential for determining whether credit risk on a financial instrument has increased significantly since its initial recognition and for measuring expected credit losses. The standard allows entities to apply different approaches for different financial instruments. While it's common for the approach to include an explicit probability of default, or PD, this isn't mandatory. Even without an explicit PD, the approach can still meet the requirements of Ind AS 109, provided the entity can distinguish changes in the risk of default from other factors like collateral. For example, if you're assessing the credit risk of a financial instrument, you need to focus on these three factors. 1. The change in the risk of default since initial recognition. 2. The expected life of the financial instrument. 3. Reasonable and supportable information that impacts credit risk. Now, let's dive into the concept of 12-month risk of default. In many cases, changes in the risk of default over the next 12 months can be a good approximation of changes in lifetime default risk. However, this doesn't work for all financial instruments. For instance, if a financial instrument has significant payment obligations only after 12 months, then the 12-month default risk won't capture the true picture. If macroeconomic changes or other credit-related factors influence credit risk beyond the 12-month horizon, they must also be considered. Similarly, if credit-related factors have a more pronounced impact on default risk after 12 months, focusing only on the next 12 months might lead to an incomplete assessment. For financial instruments where historical default patterns are evenly distributed across their expected life, the 12-month risk of default might be enough. But for those with payment structures or risks concentrated in the future, a more tailored approach is necessary. Thanks for watching.